Okay, Chapter 13, the Statement of Cash Flows. This chapter covers the fourth and final financial statement that is provided in an annual financial package submitted by all publicly traded companies to the Securities and Exchange Commission on an annual basis. So this generates their ability to generate cash to meet their financial expectations and obligations. And as I mentioned in the first chapter, the two overarching goals of any for-profit entity is to generate a profit and to maintain liquidity. So this report gives investors and readers of financial statements insight into that second goal. So it's used by managers in planning, investing, and financing activities, one of the three activities along with operations that the financial statement is broken down to. And as I mentioned, it also gives outsiders insight into the liquidity of an organization. So the three activities that the statement addresses is cash flow from operating activities. So this is the day in, day out activities that entities do in selling their goods and services. It is from investing activities, so cash, where is it being used? Purchase of fixed assets, long-term assets, whether they be tangible or intangible. And then lastly, cash flows from financing activities. So where outside of operations are they generating cash? Are they borrowing the money? Are they selling new equity, new common stock, and the like? So that's the rest of the balance sheet, long-term debt and the stockholders' equity section. So this is the way the cash flow statement is presented. So we're going to calculate cash flows or cash used, whether if it's negative, from each of the three activities, operating, investing, and financing. That will give us the net change in cash. Add that to the cash at the beginning of the year, and we should get the cash at the end of the year. So this is another statement, just like the balance sheet, that when you get done with it, you have a reasonable expectation that you have done it correctly. So we're going to be addressing cash inflows and cash outflows. So under operating, cash inflows is from the sale of products and services. Cash outflows is to buy the inventory for retail and merchandising and manufacturing entities, pay employees, to pay vendors, and to pay your taxes. Investing is from the sale of property, plant, and equipment or investments. And then investing outflows are buying new tangible property, plant, and equipment, intangible assets like patents, trademarks, copyrights, and the like, and to purchase investments, whether they're long-term investments. And then financing is issuing long-term debt or issuing new stock. Outflows include paying dividends to shareholders, buying treasury stock, or repaying the long-term loans. There are two methods by which this statement can be presented, either the direct method or the indirect method. The direct method goes and identifies cash received, and the change between the direct and indirect method only affects the first section, the cash flows from operating activities. So we have cash received from customers, cash payments to merchandise, operating expenses, interest, and taxes. The indirect starts with net income, and then it makes various adjustments to reconcile that net income to net cash flows from operating activities. These adjustments include any non-operating items, such as selling of fixed assets, gains and losses on the sale of fixed assets or investments, and non-cash items such as depreciation. Then we're going to look at current assets and current liabilities and do net changes to those accounts. So the indirect method is overwhelmingly the most popular way of presenting this financial statement for U.S. companies, and as such, we're going to focus on the indirect method. So the advantage is it does tie in the income statement because it starts with net income. So I think it provides the reader a little bit more insight into the available. So here's an example. So cash received from customers, that's sales plus changes in accounts receivable, whether it increased or decreased. And then payments for creditors, expenses. This is your operating expenses as well as cost of goods sold, with net changes in inventory and net changes in accounts payable. Whereas here, we start with net income. We have an increase in accounts payable. That's a current liability. So if a current liability goes up, cash goes up because you're not paying those particular vendors. And then a net increase in supplies. This is a current asset. Current assets have an inverse relationship to cash. So as current assets go up, accounts receivable, supplies, inventories, prepaid expenses, cash goes down. Right? They're going to come up with the same answer. Whether you you do the indirect or indirect method, it's both going to come up with, in this case, the $2,900 net cash flow from operating activities. So investing activities are the rest of the long-term assets of the balance sheet, so net changes in that. So purchase of new land, purchase of a new building, purchase of manufacturing equipment, selling of that. So cash derived, not the gain and loss. The gain and loss will be removed from the financial statement in those adjustments under the indirect method. This is the cash derived from cash inflows from the sale of fixed assets, investments, or intangible assets. Financing activities are the long-term liability section of the balance sheet. So changes in long-term liabilities, changes in bonds payable, mortgage payable, and the like, and then changes to the stockholders' equity section. So sale of common stock or preferred stock, the payment of cash dividends, acquiring treasury stock, and the like. That's what this one just said. Then your book presents non-cash investing and financing activities as a footnote. I don't necessarily agree with that presentation. What I do and what I'll be doing in the problems for Chapter 13 is I will go through and separate them out. So a non-cash activity by the author of your textbook would include things like buying a piece of equipment by signing a 100% financing note. So that's a cash inflow from new debt, borrowing a long-term liability, and a cash outflow for an investing activities by purchase of new equipment. So I would separate those two out. Your book presents it down here, down at the bottom. You come up with all the cash at the beginning and the cash at the end, and then put down here the net cash investing activities. All right, so to do these, you're going to need an income statement because you need to go in and pull out items off of the income statement that are non-operating, such as this gain on sale of land. And you also need to determine any non-cash, so the depreciation expense of $7,000. Then you'll need a comparative balance sheet. So the current assets, we're reconciling to the top line. So what we're looking for at the end of the statement of cash flows is this 71,500 increase in cash. So accounts receivable and inventories are going to be an operating activity. So accounts receivable increased by $9,000. That's a negative effect to cash because your customers are not paying you. And then inventories went down by $8,000, and that is a positive to cash. And then accounts payable for merchandising and operating expenses and income taxes payable. All of those three are also going to be operating in nature. So we start with the $8,000. Then we go to the dividends. Here's the 108 for net income. You can see that from the retained earnings statement. It started, indicated an $80,000 net change in the year, and that was net income of the 108 less the dividends that were declared in two separate occasions, June 30th and December 31st, totaling $28,000. So we're going to start with the net income of 108, and then we're going to add any non-cash or non-operating items from the income statement. And then we'll do changes in current operating assets and liabilities. So increases or decreases depending upon whether it's an asset or a liability. So we started with the 108. We add back the $7,000 depreciation. We then subtract the $12,000 because the $12,000 increased the net income up to 108. We want to decrease that to get back to just operating activities. Accounts receivable went up, as I indicated. An increase in accounts receivable is a negative cash. Inventory went down, $8,000. That's positive. The accounts payable, the accrued expenses payable, and the income taxes payable are all going to have a direct relationship. So decrease in accounts payable, $3,200, decreases cash because you're paying more of your accounts payable. So that's where the depreciation came from. Here's where the gain was, and then here's the net changes in current assets and current liabilities. So that's going to give us operating activities. So net cash flows from operating activities is $100,500. Financing activities, investing activities is going to be next, and that is off of the comparative land. So we sold a piece of land for $72,000 in cash, but then we turned around and we purchased some new land for $15,000. So a net change decrease of $45,000. So cash received from sale of land is this positive 72, and then cash paid for purchase of land, the negative 15,000. Building increased. We purchased a new building for $60,000, and then there's the $7,000 that was taken in depreciation that we accounted for up in the operating activities. So cash paid for the purchase of building, a negative $60,000. And then financing activities are any changes. You can see we retired some bonds, so the bond balance went down by $50,000, so that's a negative cash paid to retire bonds. And then we had a sale of $8,000 in common stock with an additional $40,000 in additional paid-in capital in excess of par. So a total of $48,000 cash received from the sale of common stock. And then we paid our dividends in two separate occasions, as we mentioned earlier. The dividend payable has increased by $4,000. So cash that we paid is only $24,000. So the $28,000, the 14 plus 14, plus the increase minus the increase of $4,000 in dividends payable. So here's the entire statement. We had a positive net cash flow from operating activities. We had a net cash flow used by investing activities, a negative $3,000, and a net cash flow used for financing activities, a negative $26,000. Subtract those two negatives from the positive from operating, and you get a net increase in cash of $71,500. Cash balance of $26 at the beginning of the year gives us the $97,500 at the end of the year. The difference between this and the direct method is the direct method would have calculated the net cash received from customers, the cash payments for merchandise, for operating expenses, for interest and taxes. We still would have come up with the positive $100,500 in net cash flows from operating activities. The investing and financing is the same. And that's it. Okay.